Advanced audit issues. Almost three areas of our syllabus we have covered so far. Audit report, ethical and other professional issues, and audit planning and risk. So moving now, still covering one topic relating to planning and risk, and then we'll move towards the last area of our syllabus, non-audit engagements. Let's discuss the topic, top-down approach. There are different approaches of audit. One is called a system-based approach. System-based approach means test of control with reduced substantive procedure. When client control system we have evaluated are strong, we adopt system-based approach, mean we will perform test of control with reduced substantive procedure. Main areas we will perform substantive procedure, the rest of the area we will perform test of control. The other approach is substantive approach. What is substantive approach? If we have evaluated control system of the client are weak, we will not perform test of control. We will perform substantive procedure on each account balance. The other approach is risk-based approach. What is a risk-based approach? Auditor first will highlight risky areas, the areas where there are more chances of misstatement. Then he will design his audit approach, mean the areas where there is a high risk, he will perform substantive procedure. The areas where there is a low risk, he will perform test of control. Mean in one audit, it's not necessary auditor is adopting only one approach. He might be adopting 2 or 3 approaches. The third approach is called a top-down approach. What is top-down approach? To highlight risky areas, first auditor will identify business risk of the client company. And based on each business risk, he will identify risk of material misstatement. Like if our client is operating in fashionable products, what is business risk? If he's operating in fashionable products, inventory could become obsolete and business is suffering obsolete inventory losses. This is what business risk. Against each business risk, he will identify risk of material misstatement by having an impact on the financial statement. If client is facing obsolete inventory losses, there are chances that inventory could be overstated if not adjusted per IAS to lower of cost and NRV. Client has invested money in property and property market in slump nowadays, and client is facing huge losses. This is what business risk. What could be the impact of this business risk on financial statement? If there is slump in property market and he has investment in property, mean he has recorded as an asset. So there are chances if client is not performing impairment review of their properties. So chances that expenses could be understated and profit asset overstated. This is what risk of material misstatement. Client sale has declined and client is facing serious cash flow issues, struggling to manage short-term cash flow. This is what business risk, issue of the business. But if business is having cash flow issue per IAS 1, that cash flow issue must be disclosed in the financial statement. If there is no disclosure in the financial statements, what is this? Risk of material misstatement. Mean first auditor will identify business risk, and based on business risk, he will identify risk of material statement by thinking about the effect of that business risk on the financial statement. So this is called the top-down approach. What is business risk? Risk of material statement. What is risk of material statement? What is risk of material statement? A risk that misstatement may occur in the financial statement. What is business risk? A risk that business may not achieve its objective. A risk that business may not achieve its objective. In all the issues of the business, due to that, if business is unable to achieve its objective, mean profit, so that is called business risk. And there are three types of business risk: financial risk, operational risk, and compliance risk. What is financial risk? All the issues relating to finance, relating to money, relating to financial statements are called financial risk. Mean issue of the business, like company sale has declined. This is what financial business risk. Company GP margin has reduced. This is financial business risk. Gearing has increased. This is financial business risk. Current ratio has decreased. This is financial business risk. Return on capital employed has decreased. This is financial business risk. Business is short of cash. This is financial business risk. Business need to invest money to run their operation, but they don't have a finance. This is financial risk related to finance, money problem. What is operational risk? Issues in the business operation. Employees are not properly trained, so they will not be able to provide high quality goods or services to the customers, and customer will not be satisfied. Company will lose a sale. This is what operational risk. Ultimately, it will affect business objective, mean profit. But the issue is where? In operation. Employee turnover is high. Company machinery is outdated. From production, business is producing too much of faulty products. Company staff is on strike from last 1 week. These are all issues where in operations. Ultimately, these will affect business objective, mean profit. But this is not financial. This is operational risk, mean problem in business operations. What is compliance risk? A risk due to non-compliance with law regulation. If business do not comply with law regulations, there could be chances of fines, penalties. Fines, penalties will affect the business objective. Our business operation will become banned by the government authorities. But the issue is where? Compliance of law regulation. So this is business risk, but what? Not financial, not operational. This is compliance business risk. So what is top-down approach? Instead of identifying risk of material statement directly, auditor will identify business risk of client company first. Then against each business risk, he will find the effect on financial statements and what could be chance of misstatement in financial statements to highlight risky areas, mean risk of material statement. There could be some advantages of this top-down approach. Could be some disadvantages of this top-down approach. What could be advantages of this top-down approach? No, this will increase your time. Because instead of directly identifying risky areas, you first identifying business risk, spending time on identifying business risk. Then against each business risk, you will check what is the effect on financial statements, what could be the chance of misstatement. You are highlighting risky areas in financial statements. So it is a time consuming. So this is what disadvantage. And ultimately, the more time you will spend on a client, ultimately it will be costly for the auditor as well. And this cost will increase audit fee for the client. Because the audit cost to whom you will charge? Client. What could be the advantage? Through this, you will be able to highlight so many risks, because first you have identified business issues, and then against each issue you are finding impact upon financial statements. So this could improve audit quality. When you are finding a business risk first, so by finding businesses, you will be having more detailed knowledge about client. So this will provide more detailed knowledge about client business. And if you have identified business risk, you have got full detailed knowledge about client business. So in case client need any non-audit engagement in future, so that area you have already performed and you will be providing those non-audit services with less efforts, with less cost. So help in providing non-audit engagements. What is non-audit engagements? That we'll discuss later on, like business consultancy services. So there are some advantages of top-down approach. There are some disadvantages of top-down approach. Sometimes our client, instead of asking to conduct audit of their financial statements, they could ask a separate assignment. Can you please identify our business risk and recommend some measures how we can overcome those risks? This could be a separate assignment for audit firm, not audit. This is what non-audit engagement. To evaluate business risk of the client. Why client want to identify business risk? So that they can manage those risks, they can have an approach, they can have an help how they can resolve their business issues. Because might be client management is not that much expert to identify their business issues. From external person, especially from the audit firm, they are having a vast variety of knowledge and experience while working in different organizations. So they could identify even more risky areas for the business. Let's move towards this question. Julie. There are three requirements of this question. Requirement A for 16, having 4 professional marks, mean 20 marks. Requirement B for 10 good marks. And requirement C for 5 marks. Requirement A of the question. Prepare briefing notes to be used at a planning meeting with your audit team, in which you evaluate the business risk facing Jolie company to be considered when planning the final audit for the year ended 30th November 2020. We need to identify and evaluate what? Business risk, not audit risk, not risk of clear statement. When we are identifying business risk, we should forget like we are auditor. We should answer this part like we are answering a question of SBL, where we are performing pestle analysis, 5 forces analysis, or SWOT analysis, mainly SWOT analysis. In risk of material misstatement question, each risk we need to link with the misstatement in the financial statement. But in business risk, we do not link with the financial statement. We need to link each issue, each risk with the business objective, with the business position, with the business profit. We should attempt this part while we are attempting SBL question, not AAA question. Link each issue, each business risk with business objective, with business position. This could affect business position badly. This could create a hurdle in meeting objective of the organization. This could increase business cost and affect business profit. Impact on business we need to explain, not on financial statement. Please be careful. This is not audit risk question. This is business risk question. And normally after 4 to 5 attempts, examiner test this business risk question in the exam paper, especially in question number 1. And students struggle. Why? Because they are linking with the financial statement like audit risk. This is not audit. So 16 marks are there. If we identify 8 good business risk and explain 2 marks each paragraph, like in SBL, so we can tackle this part. So we need to prepare briefing notes. In these 4 professional marks, 2 marks are the format of the briefing notes, 2 from subject, date, introduction. And 2 marks are relating to your flow of answer, mean how clearly you are answering the requirement. And that 2 marks relating to clarity of your answer that we can cover if we are providing different point in separate paragraph. Like 1 mark, 1 point, valid point. For business risk, 1 valid point mean 1 paragraph for 2 marks. 2 marks, 1 paragraph mean at least 4 lines, not more than this. Otherwise, we will not be able to complete our paper. Not lesser than 4 lines. Otherwise, we haven't justified 1 point for 2 marks. Examiner will not award 2 marks probably. 2 marks, 3.6 minutes. So in 3.6 minutes, on paper, we can write down 5 to 6 lines, but in computer, 3 to 4 lines maximum, not more than this. Is that? So we are moving towards identifying business risk. Jolly Company is a large company operating in the retail industry. With the year ended 30th November 2010, you are manager in Jen and Company responsible for the audit of Jolly Company, and you have recently attended a planning meeting with Mofit, the finance director of the company. As this is the first year that your firm will be acting as auditor for Jolly Company, is there any issue if you are going to conduct audit for the first time? There is detection risk, audit risk. We are going to identify business risk. Ignore this. So you need to gain an understanding of the business risk facing the new client. Notes from your meeting are given below. Jolly Company sells clothing with a strategy of selling high fashion items under the JLC brand name. New ranges of clothes are introduced to stores every 8 weeks. The company relies on a team of highly skilled designers to develop new fashion ranges. The designers must be able to anticipate and quickly respond to changes in consumer preferences fashion. There is a high staff turnover in design team. There are 2 issues for a business in this paragraph. First, company is operating in highly fashionable products, and that product become out of fashion every 8 weeks. Is that? And if company haven't anticipated the fashion properly, and they have produced too much inventory, that will become out of fashion after 8 weeks. And if company not adjusting inventory as per IES to lower of cost and RV, inventory could be overstated. No. We are identifying business risk, not audit risk, please. So if company unable to identify inventory according to fashion and they have produced too much, so company will be having huge out of fashion inventory losses that would affect the business objective. So fashionable products. So business will be facing huge obsolete inventory losses that would affect objective of the organization. Not for IES to businesses, we don't need to even discuss accounting standards. Have we discussed accounting standard in Pastel 546 SWOT analysis? No. So treat this question like SWOT. And then there is a high design team staff turnover. So design team staff turnover is a high. If there is a high turnover in design team staff. Ultimately, the new staff will take some time to understand the industry. Then they will be able to design new products for the company. Until that time, company will not be able to introduce something new on time. And if company is delaying to introduce something on time because their previous designer have left the company, so this could affect the company customers. This could shift the company customers towards a competitor, and company will not be able to survive in the industry. Are you with me? Business risk, impact on business. Impact on business. So out of 8, 2 we have identified. Most sales are made in store, but there is also a very popular catalog from which customer can place an order online or over the phone. The company has recently upgraded the computer system and improved the website at significant cost in order to integrate the website sales directly to general ledger and to provide an easier interface for customer to use when ordering and entering their credit card details. The new online sales system has allowed overseas sales for the first time. First company have introduced new IT system. If controls over the customer payment detail not working effectively, and customer payments details could be hacked, could be misused by the hackers or any of the staff member of the company. Company need to pay damages to the customer, and this could affect the company repute as well as profitability in future. Is that? And company is going for overseas sales for the first time. If company is going for overseas sale, what could be the issue? Due to adverse rate in foreign exchange rate, company could face huge losses, foreign exchange losses that can affect position of the company. Not IAS 21. Please control yourself. This is business risk, not risk of DM statement or audit risk question. The system for phone ordering has recently been outsourced. They have outsourced their phone ordering system. Like in India, Pakistan. Where you from? Nepal. Sometime here I'm working in a call center. What are those call center? The brand of UK, Europe, USA, their customer service department, they have outsourced to any of the call center in India, Pakistan, Bangladesh, Nepal. If a customer in America, sitting in America, he is calling to the brand local number who is answering that call, a person sitting in India, Pakistan, Nepal. Why? Because the cost is lower in those countries. They cannot establish their customer service department in USA because the phone cost is higher over there. Rent of the office are higher over there. Even staff is expensive over there. So this company has outsourced their phone ordering system. The contract for outsourcing went out to tender, and Jolly company awarded the contract to the company offering the least cost. They have outsourced based on the least cost rather than quality. And the company is providing a high fashion products. Who will be the customer? The rich class, the upper class. And they want what? High quality services as well. And company providing the services uses an overseas phone call center where staff costs are very low. Due to language barrier, even due to cultural differences, because the culture of UK, USA is different than the culture of these Asian countries. These Asian countries, people can wear one suit on every occasion. They can wear that suit for party, birthday party. They can wear that suit for wedding. They can wear that suit for day party, night party. But in UK, USA, Europe, there are different types of cloth for day party. There are different for night party, different for wedding, different for birthday parties. This is what cultural issues. Even the fashion in USA will be introduced in India, Pakistan, probably after 5 years. People adopt that fashion 5 years later. So due to this language barrier or cultural issues, that call center staff will not be able to satisfy the customer. This could affect repute of the business as well as lose customer towards a competitor, and business position could be affected in the market. So this is what outsourcing phone ordering. Because you have outsourced based on the cost only, you haven't verified the quality of the services provided by that call center. Jolly Company has recently joined the Ethical Trading Initiative. Ethical Trading Initiative means now onward we will perform business operations ethically. Ethically means we will care about all the stakeholders. We will care about the employees. We will not allow the child labor. We will limit the damage to the environment as well. This is what Ethical Trading Initiative. This is a fair trade initiative, which means that any product bearing the JLC brand name must have been produced in a manner which is clean and safe for employees and minimizing the environmental impact of the manufacturing process. And we will care about the environment, we will care about the stakeholder, about the employees as well. A significant advertising campaign promoting Jolly Company's involvement with this initiative has recently taken place. And they have advertised it. Like from now onward, we are moving towards ethical trade initiative. Ethical trade initiative, and company have advertised it so much. And if you have advertised, you are moving towards ethical trade initiative. And if on the other side, company is having an association with any of the supplier who is producing goods through, say, child labor, mean not performing ethical business. So your association with unethical people, unethical stakeholder could even damage your repute more. Because you are performing ethical trade by yourself. But if other like your supplier are not performing ethical business, so your association with them, like you are supporting them, this could affect your repute even more than before. And this could lose your customer towards a competitor, and business will not be able to survive. Because you can look at areas in your business, but not other. And you have advertised it too much. Like we are performing ethically, but other, if not performing, and you are unable to check, this could destroy your repute. A significant advertising campaign promoting JLC involvement with this initiative has recently taken place. The JLC brand name was purchased a number of years ago and is recognized at cost as an intangible asset, which is not amortized. The company is not amortizing the brand. If they are not amortizing per IAS 38, no, we should ignore this. We should ignore this because we are finding business is not risk of dealership. The brand represents 12% of the total asset, highly material as well. Ignore. Don't discuss accounting. Don't discuss audit risk. The company owns numerous distribution centers, some of which operates close to residential areas. A license to operate and distribution center is issued by each local government authority in which a center is located. One of the conditions of the license is that delivery must only take place between 8 a.m. and 6 p.m. And if company is not meeting the condition, government authority will revoke the license. With the revocation of the license, business will not be able to perform operations. This could create a serious problem for the business and affect its position. The authority also monitor the noise level of each center because you are operating near to residential area and can revoke the operating license if a certain noise limit is breached. 2 licenses were revoked for a period of 3 months during that year. And 2 licenses have already been revoked. And if company is still not further complying with the condition attached to the license, so authorities could revoke other licenses, and this could create serious operational problem for the business, and it could affect delivery to the customers as well as the sale of the business. So license we can put heading. How many risks we have identified? One relating to fashionable products, high staff turnover in design team, new IT system, overseas sales, own ordering, ethical trade initiative, license, altogether 7. We need to identify 8. To help your business understanding, Mobit has emailed you extract from the draft statement of profit or loss and other comprehensive income and the relevant comparative figures which are shown below. Extract from draft statement of profit or loss and other comprehensive income. Revenue. There are 2 types of revenue, retail outlet and phone and online sale, mean e-business. If you look at revenue from 2009 to 10, retail outlet revenue has decreased, online sale has increased, but overall revenue has decreased. Company revenue has declined by this percentage. Can we calculate percentage as well? If we look at operating profit, it also has decreased, finance cost slightly increased, and profit before tax also decreased. And we can calculate profit margin, operating profit over sales multiplied by 100, and profit margin, if you see, has decreased from 2009 to 20Y0. Is that? We'll put the heading what? Financial risk. Under financial risk, we will discuss this sale growth that has been declined as well as profit margin that was this in previous year and has declined to this, mean businesses are unable to manage their fixed cost, and this could affect the business position badly. There is further information given. Additional information, number of stores has increased by 2. Average revenue per store has decreased. Business is losing customer. Number of phone orders has decreased and number of online orders have become doubled. But average spend per order was 300, mean before in previous year customer was buying 300 products from you in one order. Now they are buying $250 in one order. For other $50 they are sourcing from other suppliers. This means they are not satisfied with your products. Might be you are unable to introduce products according to the current fashion, are better than your competitor. That's why average spend per order from customer has reduced, and this could affect company position badly. So this average revenue per store and average spend per order, these 4 points we can discuss under financial risk. Now we'll be able to tackle this question for 16 marks. Is that part B of the question? Using the information provided, identify and explain 5 risks of material misstatement. Now identify 5 risks of material misstatement. 5, 10 marks. This means relating to accounting standard we need to discuss. First, fashionable inventory will become obsolete if inventory is not adjusted lower of cost as per IAS to lower of cost, and NRV inventory could be overstated. Is that? Okay, then companies moving towards overseas sales. It's not branch, it's not subsidiary. So if foreign exchange gain loss is not charged to profit and loss account, financial statement could be manipulated. Company have introduced new IT system. Due to early stage control weaknesses, i.e. teething problem, chances of errors in financial statement. Is that? And then company have moved towards, due to this new IT system, companies are moving towards online sale. Is that? Online sale. In online sale, there are two issues. One, revenue recognition. If company is recording revenue based on the ordering rather than based on when performance obligation arises due to non-compliance with IFRS 15, revenue could be overstated, liabilities understated. And there is an e-commerce risk if the controls over customer payment details are not working properly. Due to misuse or hack of payment detail, company need to pay the customer damages. This could create serious cash flow issue for the company, which may not be disclosed properly per IAS 1. Is that? Now that the brand name that was not amortized, if per IAS 38, brand is not amortized, chances that assets profit could be overstated, expenses understated. And then 2 licenses revoked. Company have breached the condition relating to the license, there could be chances of fine penalties. This means there could be chances of recording provision per IAS 37. If company haven't recorded the provision per IAS 37, chances that expenses, liabilities could be understated and profit overstated. Can we discuss 5 risk? Easy. Now part C for 5 marks only. Recommend the principal audit procedures to be performed in respect of the valuation of JLC brand name. Relating to JLC brand name valuation, you need to write down 5 procedures. Mainly the issue is that they are not amortizing. So main procedures 3 must be for amortization. Can you try this part for yourself? 5 on procedures. So first we can, this brand was purchased. This brand was purchased. So we can inspect the purchase agreement to verify the amount of the brand. And we can inspect a cash book bank statement to verify payments. Is that manual level decision? Obviously, when they have purchased, they have decided in board meetings, so review board minutes to verify authorization for the purchase of brand name. And now relating to amortization, we need to, because valuation Mainly valuation is overvalued because company is not amortizing. So what we will do, we will discuss with management the reason behind not amortizing the brand, whether it is having indefinite life. Because if the brand is a indefinite life, there's no chance for amortization. So we need to discuss with the management the reason behind no amortization, whether it is having indefinite life, to see if reasonable. Second, we can consult independent expert regarding the life of the brand, because if life is not indefinite, then what is the life of the brand? By how much amortization is required? So we need to consult independent expert regarding useful life of the brand. Recalculate amortization using the useful life information obtained from the expert and compare with management calculation for accuracy. And if they are saying no, life is indefinite, so this is assumption based, estimate based. So obtain written representation from management regarding reason behind no amortization required for the brand. Is that 5 procedures, but relating to valuation, not brand name. Mean 3 procedure at least should be there relating to verification of amortization, like depreciation. Recognize that cost is fine. It's asset they have bought, what amount they have paid, they will record initially on cost, purchase cost. But afterward, it should be based on carrying value, mean cost less amortization. So moving forward now. So moving towards last area of our syllabus. No, we will take next 2 more lectures, Saturday and Sunday, 6 more hours after that. Audit versus non-audit engagements. Audit versus non-audit engagements. An audit firm not only perform audit services, they also perform other services as well. Like if company do not have their accountant disappear, become mad, or dead. So company need to prepare financial statements. How they will prepare if they don't have the accountant? They will come to our firm. They will request us, please prepare our financial statements. What we will do, we will prepare financial statements according to the data available in the client and will charge a fee for that. This is called non-audit engagements. If a client doesn't have internal audit department, but they need to review their internal control system, so they can ask us, please review our internal control system and highlight weaknesses and recommend measures how we can overcome those weaknesses. So perform this assignment. This is not audit. This is what non-audit engagements. A client need finance. Finance client can get either by issuing shares or through debt mean loan. So for share, there is no option. So they visited a bank. They asked the bank, we need a loan. Banker said, yes, this is our business. We provide a loan because we are charging interest. But we cannot decide how much loan we should grant for your business. We need to see your cash flows. So please prepare your cash flow statement so that we can see how much inflows you are having, how much outflows you are having, and based on the worth of cash flow, we'll be able to decide how much loan you are eligible for. Then we will decide a loan. Company said, okay, this is not issue. They asked their accountant, please prepare cash flow statement. He prepared cash flow statement. He's emailed to the manager. Manager was sitting in the bank. He presented cash flow statement to the banker. This is my cash flow. These are inflows. These are outflows. Now tell me how much loan you can provide to us. Banker said, I cannot rely on this cash flow statement because this is prepared by you. Please go and take a opinion on this cash flow from any of the audit firm. Based on that opinion, ultimately the reliability, the authenticity of this cash flow will be enhanced. Then we will be able to decide. So company managers visited our office. Who are we? Audit firm. We are running audit firm from very first day of this course. So they visited our office. They requested us, can you please approve this cash flow statement? We said yes, but we'll charge this fee. Manager agree, okay, I will pay you. So we checked their cash inflows, cash outflows from their accounting records, and we approved the cash flow statement. For whom? Bank. For whom we have approved the cash flow? For bank only, not for any other person. This approval of cash flow statement is audit? No. The word audit means giving opinion on financial statement. And the word financial statement means set of 5 components. If we are giving opinion on any one component of the financial statement, that is not audit. That is what? Non-audit. Is that? One of the investor is having interest to invest in company shares. You want to buy company shares. He asked the company management, I can see your past from your financial statements. Can you please show me your future? How company can show his future? The projection through forecast. So company prepare its forecast projection and hand it over to the investor. See, this is our future. Investor visited our office with that forecast and projection. Can you please verify this? If we can verify, what we does, we took the past financial statements of client company based on the past 5 to 10 years trend. We identified if the same trend has been followed in the forecast and projection. This means this forecast projection is accurate. So based on that, we have given opinion on this forecast or projection. For whom? For that investor only. Is that audit? No, audit means to express opinion on the financial statement. If we are giving opinion on cash flow for banker, if we are giving opinion on forecast for the investor, this is not audit. This is what? Non-audit engagement. This means what is audit? Audit means to express opinion. To express opinion on financial statement. Engagements other than audit are called non-audit engagement: accountancy services, taxation services, internal audit services, opinion on any one component of the financial statements, giving opinion on forecast for the investor. If client have requested us, can you please evaluate my business risk and recommend measures how I can overcome this? This is what business risk evaluation assignment. This is not audit. This is what? Non-audit engagements. And firms generate most of their revenue from non-audit engagements. You can say about 3/4 of their revenue, only 1/4 revenue, like 20 to 25% they generate through audit. The rest all revenue they generate through non-audit services. And these are allowed, not disallowed. But for the audit client, ultimately there is issue of self-review threat. So we can perform through Chinese wall, means separate team for audit, separate team for non-audit. So audit means to express opinion on the financial statement, whether financial statements give true and fair view or not, and prepared according to accounting standard. In that opinion, we provide assurance rather than guarantee. If we are saying financial statements give true and fair view, we are providing what? Assurance. Assurance means confidence, not a guarantee. Auditor never ever provide guarantee because our work is sample based. We do not test 100%. That's why we cannot provide guarantee. Even if we provide 100% testing, still we cannot provide a guarantee. Why? Because the records, who prepared those records? Client management. We haven't prepared those records. We are verifying figures through accounting records. Who prepared those records? Client management. Those could be fraudulent. So in audit, auditor provide opinion on financial statement. In opinion of audit, auditor provide assurance rather than guarantee. And the assurance that auditor has provided, that assurance is called reasonable assurance rather than absolute assurance. Reasonable mean less than 100%. Absolute mean 100%. Should never provide 100% assurance near to guarantee. He provide reasonable assurance less than 100%, like 70 to 80%. Why? Because the nature of audit evidence that we have obtained is persuasive rather than conclusive. Auditor obtain persuasive audit evidence rather than conclusive. Persuasive mean less than 100%. Conclusive mean 100%. Mean our work is based on sample. Sample mean less than 100%. We perform procedure on sample of whole population. We cannot test all the transaction. That's why we are having persuasive audit evidence. Persuasive mean kacha paka evidence, not paka paka like conclusive evidence. That's why we cannot provide absolute assurance or guarantee. We provide reasonable assurance, mean less than 100% assurance. So firstly, the assurance provided in audit is reasonable, mean less than 100%. The assurance provided in audit is also called positive assurance. Positive mean auditor express his assurance directly. Directly mean financial statements give true and fair view. Our financial statements do not give true and fair view mean he expressed straight away. Financial statements give true and fair view, do not give true and fair view, or except for this give true. There's no ambiguity. He expressed directly. That's why the assurance provided in audit is called positive assurance as well. The assurance provided in audit is reasonable, positive, as well as a high level assurance. Not low level, not moderate level. In audit, we provide a high level assurance. What does it mean by high level assurance? The assurance we are providing in audit is not for one particular user. It is for more user. Those shareholder have appointed us. Mainly our opinion must be for shareholder, but it is not only for shareholder. It is usable for other stakeholder as well. Investor can take decision, investment decision based on an audit opinion. Banker can take their decision, loan sanction decision based on audit opinion. Customer can take decision based on audit report. Supplier can extend credit limit based on audit report. Even government authority, taxation authority will rely on audit opinion whether client is paying correct amount of tax or not. It is not only for shareholder. If we want to limits our liability towards particular stakeholder, so we can use other matter paragraph. If we haven't used that other matter paragraph for limiting liability, so our opinion is open for more stakeholder. Anybody can take decision relying on our audit opinion. And if our opinion proved wrong due to our negligent work, we will be paying damages to all the stakeholder, not only to shareholder. So our audit opinion is for more user. That's why it is called a high level assurance. It is called high level assurance. Why? Because we are providing audit opinion through application of extensive audit work. we have applied extensive audit procedures. I mean, we have performed variety of procedures. We have performed test of control. We have performed substantive procedure. We have performed analytical procedures. Even substantive procedure we have performed in interim audit, then in final audit again, we have reviewed the financial statements. That's why our audit assurance level is high. Level is high mainly due to extensive audit procedure. Extensive audit procedure means substantive procedure. Substantive procedure means detailed work. Though we have performed on sample basis, but we have performed detailed work. That's why audit assurance level is high. So in audit, we provide opinion on financial statements. In that opinion, we provide assurance rather than guarantee. And that assurance we are providing in audit is called reasonable, less than 100%. Positive mean we are expressing directly, and a high level because we are providing assurance for more user and through application of extensive audit procedures. In non-audit, we could be asked to provide assurance, like we are providing assurance on cash flow for the bank. We are providing assurance on forecast for the investor. But the assurance that we are providing in non-audit will be assurance, not a guarantee. But that assurance will not be reasonable. It will be lower than reasonable, called limited assurance. Like if reasonable is a 70 to 80%, limited could be 60% or 50% assurance. So why? We're going to discuss later on. We do not provide reasonable assurance in non-audit engagement. The assurance provided in non-audit engagement will not be positive. It will be negative. We will not express directly. We will express indirectly. How we will express indirectly? Nothing has come to our attention. That causes us to believe financial statements do not give true and fair. What does that mean? Nothing has come to our attention. We couldn't identify anything that causes us to believe. Based on that, we can say financial statements do not give true and fair view. Mean in simple word, financial statements are true and fair. In simple word, financial statements are true and fair. There is nothing wrong with financial statement. But we are not saying directly like financial statements give true and fair view in audit. In non-audit, we express in indirect way, negative assurance. Nothing has come to our attention that causes us to believe financial statements do not give true and fair view. In fact, not negative, it's a double negative, nothing and do not. Why? We're going to discuss later on. So in non-audit, the assurance we are providing is not reasonable, it is limited, mean below reasonable. And it is not positive, we express in indirect way, that is called a negative. And the assurance we provide in a non-audit engagement is not a high level. It's a moderate level or low level. What does it mean by high level? Providing assurance for more user. In non-audit, we do not provide assurance for more user. It is for a particular user. If we have provided assurance on cash flow for the bank, it is only for the bank, not for any other person. If we have provided assurance on forecast for the investor on his request, it is usable for the investor only, not for any other person in the world. If anybody else is taking a decision based on that assurance, will not be liable for that because you haven't paid to us. We are not liable for that. High level mean for more user, low level mean for particular user. High level mean we are providing assurance through use of extensive audit procedure, detailed work, substantive procedure. In non-audit engagement, we do not perform extensive audit procedures. We do not perform substantive procedures. We are providing assurance through 3 limited procedures. What are those 3 limited procedures? Analytical procedure, inquiry, and written representation. No test of control, no substantive procedure, no inspection, no external confirmation. What we will do, we'll just compare current year data with the previous year to see what if there is any difference. We will see what is the reason for this difference. If we could understand the reason, okay, fine. If we are unable to understand why there is a difference, we will ask the client management why there is a difference. They will say due to this, okay, done. Why there is a difference in this figure? They will say due to this. Okay, it could be due to this. Can you please provide us a written representation as well? They will say yes. So we'll take that as evidence. Mean we haven't performed inspection of the document. We haven't performed physical inspection of the asset. We do not confirm balances externally. We are just relying on the records, on the client information and their written representation. In an audit, if we need to verify asset and inventory, what we do, we inspect their documents. We move there at that place where documents are presented. We perform physical inspection. How we perform physical inspection? We move the area where those assets are, where that inventory is stored. But in non-audit, we do not move anywhere. We are performing procedure while sitting at one table and chair only. At that table and chair, we ask the management, okay, provide us the document that we can compare current with the previous. If we are unable to identify the difference between any figure, we will call to the management why there is a difference. They will say due to this, okay, good. We'll write down in the working paper. Why there is a difference? They will say due to this, okay, please, can you send me a written presentation for that as well? They will say, yes, I will provide you a written presentation. We are not moving anywhere. We are performing all the work while sitting at one table chair, as we haven't performed detailed work, substantive procedure, inspection, physical inspection. So that's why the level of opinion provided in non-audit is not limited, it is below reasonable. Is not a positive, it is negative, because we don't have that much evidence. Based on that, we can say directly. And the level of assurance is low level rather than high level. Are you with me? So if examiner asks what is the difference between reasonable, absolute, and limited assurance? Reasonable assurance means providing assurance below 100%. Absolute assurance means providing assurance 100% near to guarantee, and auditor never ever provide absolute assurance. Limited assurance means providing assurance below reasonable. And we provide limited assurance in non-audit engagement due to application of 3 limited procedures, this, and this. The examiner asks, what is the difference between positive and negative assurance? Positive assurance means directly expressing like financial statements give or do not give and fair view. And we provide positive assurance in audit only. Negative assurance means indirectly expressing like nothing has come to our attention, blah, blah, blah. And we provide negative assurance in non-audit engagements due to application of 3 limited procedures, this, and this. Examiner is asking what is the difference between high level and low level assurance? High level assurance means providing assurance for more user through application of extensive audit procedure, i.e. substantive procedures. And we provide high level assurance in audit only. Low level assurance means providing assurance for a particular user through application of 3 limited procedures, this, and we provide low level assurance in non-audit engagements. Is that? Okay. So we try to differentiate between audit and non-engagement, and we try to differentiate between different form, different levels, different types of assurance. So in audit, reasonable, positive, high level. In non-audit, limited, negative, and low level. Like if suppose these are different levels of assurance. This is what absolute, this is what reasonable, this is what limited, this is what say 100%, this is say 75%, this is say 60%. Now let's discuss what are the types of non-audit engagements. That is the main topic. The last area of our syllabus is what? Types of non-audit engagements. There are four main types of non-audit engagements. There are two types where we provide opinion or assurance. There are two types where we do not provide any opinion or assurance. We just perform any work like accountancy, taxation work. Mean no opinion or assurance given. These are also called non-assurance engagement. Non-assurance engagement means where we do not provide any assurance or opinion. And there are two types. Audit is also assurance engagement. And these two types are also assurance engagement. But audit is of a reasonable high level assurance engagement. These two types are limited low level assurance engagement. What are the two types where we provide opinion and assurance? These are called review engagement and other assurance engagement. Review engagement and other assurance. And the non-assurance engagements are called compilation engagement. Engagement without ring. Agreed upon procedures. It's not engagement like before marriage, the engagement of ring. These are engagements with the clients, any assignment, any work. What is compilation engagement? We need to compile any statement based on the data provided by the company. What could be that? Compilation of financial statements based on the accounting data provided by the company. Compilation of tax return. We'll just compile and charge the fee. We haven't audited it. We are not providing any opinion assurance. Compilation of tax return, compilation of financial statements, or could be compilation of interim accounts, mean half-year accounts, based on the data that client have provided. Mean accountancy services, taxation services, what compilation engagement where we are going to compile a set of statement based on the data. What is agreed upon procedures? We have agreed up procedures with the client to perform. We'll perform that procedure and charge our fee. No audit. What could be that? Review of internal control system. Asset valuation. If our client is constructing his asset and he don't know what cost to capitalize, what cost to record as revenue. So we will apply the accounting knowledge. We will say you can capitalize these costs, you cannot capitalize these costs. This could be the asset value, and this asset should be depreciated over this value, record this value as a carrying value, will charge the fee. This is what agreed upon procedures. Agreed upon procedures could be business risk evaluation. The assignment we will perform, charge the fee, no opinion, no assurance. Is that? Can you understand this? Compilation engagement and agreement procedures are non-assurance engagement. We will not give opinion or assurance, but we will give a report. In that report, we will state we haven't audited these things. We have just prepared whether these things we have prepared are accurate or wrong. Who is responsible? Client, company, management, because this was responsibility of them. We are not going to provide any opinion or assurance because we haven't audited this. Why we need to provide a report? There are some standards, ISRS, International Standard on Related Services. On compilation engagement agreement procedure, there are standards called ISRS, International Standard on Related Services, and those standards guide us. If we are providing any non-assurance engagement, we need to provide a report to clarify we are not giving opinion or assurance. To resolve, what was that? Expectation gap. If we have prepared financial statements, might be public will think like we have provided opinion assurance, they are authenticated. No. We will clear in our report. We haven't provided opinion assurance on this because we have just prepared. This was the responsibility of company management to prepare. Whether these are wrong or accurate, who is responsible? Client management, not we. To avoid that expectation gap, we will provide a report, but no opinion, no assurance. Two types of non-engagements where we provide opinion or assurance are called review engagement. What is a review engagement? It's just like audit. But whole audit is compulsory for listed companies. Unlisted company, audit is not required. So what do? They ask any of the firm, can you please perform review of our financial statement? Just for their satisfaction whether we are preparing financial statements accurate or not. In review engagement, what auditor will do? Auditor will perform these three limited procedures and will give an opinion like this. And if auditor is performing limited procedures, he will charge less fee. So this could be separate assignment that client could ask who? Unlisted clients, not unlisted. If company have prepared interim accounts for any of the investor, interim mean half year accounts, because complete year is too far. He need to take decision now based on the results till now. So if we are giving opinion on interim accounts, that will not be audit, that will be what? Review engagement. If we are giving opinion on one component of the financial statement, that will be review rather than audit. Review means giving negative assurance based on three limited procedure application. If we are reviewing a financial statements, that means we are checking financial statements with these three procedures and we are expressing this negative assurance. If you are auditing financial statements, that means we are performing extensive audit procedure, substantive procedure, and we are expressing positive assurance. So for those companies, audit is not compulsory. They perform review of their financial statement. What auditor will perform? Analytical procedure, compare this with this, this with this, this with this. Discuss this with management, and obtain representation from management regarding assumption used in preparing these financial statements. No inspection, no recalculation, no confirmation. No inspection, no confirmation, no recalculation. Compare this with this, agree this with this, discuss this with management, discuss with the management, ask management, or obtain written representation. There is an other non-audit engagement called other assurance engagement. Other assurance engagement like providing consultancy services to a client. And there are further three types of these non-assurance engagement like consultancy services. direct reporting engagement, also called performing a due diligence assignment, attestation engagement, and report on PFI. So there are two types of non-engagement where we provide opinion assurance, review engagement, and other assurance engagement like consultancy services. And there are three types of other assurance engagement: direct reporting engagement means due diligence, attestation engagement, and report on PFI. What is report on PFI? We will discuss in next lecture. What is attestation engagement? This attestation engagement is similar to review engagement. Client had prepared their interim accounts for any of the investor, and investor asks us, can you please attest these interim accounts? We'll perform these limited procedures and we will put our stamp at the end of the interim accounts, and we will write down attestation and put our signature. So this is like we are providing some kind of negative assurance. In review engagement, we prepare our report. In that, we express this assurance. In attestation, we do not prepare our report. On that statement, at the end, we put our signature, write down attested, and put our stamp. And providing this stamp attesting is like giving a negative assurance. We do not attest any document without verification. How we verify any document? By applying these three limited procedures. So it's a similar like the review engagement. What is direct reporting engagement due diligence? Suppose there is a company A and there is a company B. Company A want to acquire company B. They want to acquire company B. But in how much they should buy company B, how much money they should offer, they need to decide. How they can decide? Based on the assets, based on the value of company B. If company A don't have knowledge to assess company B valuation, they will come to us. Who are we? We are what? Practitioner. They will engage any of the practitioner and will ask the practitioner, can you please check this company B assets, liabilities, records, finance, and give us a report whether we should acquire this company B or not. If we should acquire this company B, how much should be the consideration paid? How much should be the structure of the bid? Either we should pay complete amount now, either we should pay some now, some in future, or what could be the other arrangement? Please guide us. What we practitioner will do, we will move towards company B, we will check their system, we will check their records, and we'll give a report to company A. In that report, we will provide what the benefits of acquisition. And these are the positive things in company B, mean these the benefit you can get after acquisition. The problems with acquisition, mean what are the negativities of company B, that we will provide. And we will provide a structure of bid, whether you should acquire that company B or not. If you want to acquire, how much money you should spend, either you should acquire in cash only, cash plus a share option, or what could be the other settlement you can go for. What we are doing? We are conducting audit? No. We are providing a report to the investor in acquisition cases based on the target company. This is what? target company to whom that investor want to buy. Based on the direct request of one investor, we have performed one investigation and we are providing a report to the investor regarding the benefit of acquisition, regarding the problems of acquisition and structure of bid. We are helping him. This assignment is called due diligence assignment. In acquisition or merger cases, providing a report on the target company to the investor is called what? Due diligence assignment. A is a parent company, B is a subsidiary. They want to acquire that subsidiary. But before acquisition, they want to know the fair value of net assets of subsidiary. If we are calculating that fair value of net assets of subsidiary, mean these are the benefits, these are the issues, these could be the investment that you can make by providing their goodwill. So this is what due diligence assignment. This is what non-audit engagement. And if we are providing benefit with the problem, this means we are providing a similar like a negative assurance. This is what direct reporting engagement mean. Based on the request of one investor, we are directly reporting after performing a task. What is due diligence? Providing a report on target company to the investor in acquisition or merger cases. In that report, what we are providing? Benefit of acquisition, problems with acquisition, and structure of bid. All together, this is called fair value of assets acquired plus consideration paid. Are you with me? Let's move towards our question. In our notes, we are having some notes for our AAA as well, you know. Though we haven't checked those notes, we haven't. The topics we are covering are there. There is one last chapter on non-audit engagement. Now we will try to look at these notes. This is non-audit engagement chapter. In that chapter, and we are having a good question. I hope it's there. I hope it should be there. Yeah, jet spray. For 22 good marks, what we need to do? From your review as specified by your client. From your review as specified by your client, not audit. This means we are going to perform review mean non-audit engagement. The word review mean you are going to check anything through 3 limited audit procedures. The word audit mean you are going for audit. So from your review as specified by your client, mean you are going to perform any non-audit engagement. Draft a report to the board of jet spray containing your initial conclusion, in which you will provide your conclusion, mean the result of your work and their effect on structure of the offer that the company might make. In this requirement will tell you like this is the acquisition or merger case where you are going to provide what structure of the offer, means structure of bid. List in your report the other factors that it should consider before reaching a conclusion. What are the other factors? We will discuss later on. In simple word, the nature of the question will highlight whether it is due diligence assignment or not. If in any merger or acquisition cases, we are going to provide a report on the target company for the investors, that will be called a due diligence assignment. And in due diligence assignment, there are 3 content of the report: benefit of acquisition, problems with acquisition, and structure of bid. Can you please identify some of the benefits and problem of acquisition with from this question? Try to identify any benefits and problems of acquisition. Benefits of acquisition, problem with acquisition, and structure of bid. Benefits of acquisition, problem with acquisition, structure of bid, and he has asked for other factors as well. What could be other factors that we will discuss later on. So let's discuss about the benefits and problems first. So Jet Spray, a limited liability company, is an audit client of your firm. It manufactures speedboats at its yard in a coastal town. Its managing director, Mr. Bond, has had preliminary discussion with his counterpart at another company, TopDraw, with a view to Jet Spray acquiring that company. I mean, your audit client is going to acquire any other company called TopDraw. TopDraw is a design company which Jet Spray has employed for most of its model in recent years. And Mr. Bond is impressed by its expertise in advanced design, material, and testing technology. So that company is having advanced designing material technology that would provide benefit to the Jet Spray after acquisition. And after acquiring this company will be having design capability in-house. And if you're having design capability in-house, that will provide synergy to the Jet Spray, extra benefits. Is that? It has been indicated to Mr. Bond that the purchase price will to be substantial to reflect TopDraw's reputation and a high level of profitability, and that companies are having high reputation, high profitability, and that will help the Jet Spray to run TopDraw successfully after the acquisition because their reputation is high, their profitability is high. Obviously, purchase price will be higher. This is not a problem. But the benefits are more than the cost because to acquire a good company, ultimately they will ask for a high price. With low price, you can buy scrap. Is that? So there is benefit. Your firm was asked to conduct a brief initial review of TopDraw from its published accounts for the year ended 31st December 2026 and brief meeting with its managing director. You have completed this work and your main findings are as follows. So till now we have identified three benefits. The shares in TopDraw are held equally by its managing director and its design director, who is acknowledged to be among the best board designer in the country. So they are what? Best board designer in the country. This is what benefit. That expertise will provide more benefit, but there is a problem. After acquisition, they could left the company. If they leave, they are the main expertise. So company will be losing expertise, might be will not be able to provide that much services to the customer as before. And there is issue. The shares in TopDraw are equally held by two persons. If shares are held by one person to one person, you can influence. It is very difficult to influence two persons. Because if you convince one, might be other will not agree with that option. If you convince the other, might be the previous person have changed his mind. So this could put the bid price high. This could affect the negotiation power. Through this, their bargaining power will be strong because they are two. And to convince both person on one point, this is difficult. So this could be the problem. This could increase the bid price. So there is one benefit. They are the best board designer. There are two problems. One, their negotiation power will be high. And second, they could leave the company after acquisition. So that's why if we want to acquire, we should not move for cash option. We should move for cash plus share option. Because being a shareholder, they will stay with the company. They will not leave. The company capitalizes as research and development direct cost and proportionate overheads on all design work not undertaken on contract. The company have invested in R&D, and that R&D benefit will accrue in future. And those benefit will help the organization to manage a business profitably. So this is what a benefit. This is justified on the grounds that almost all ideas are eventually incorporated into some final product, and the costs are then amortized against the income arising. They have capitalized research and development cost. Research cost has also been capitalized. If they have capitalized research cost, this could show high profitability, high financial position of the company, and move towards a high bid price. Is that? So this is problem as well. And this is other factor we will discuss. Before acquisition, adjustment relating to research cost should also be required. Because after adjusting profit and assets, company will be able to define best bid price. Included in provision for liabilities and charges in balance sheet at 31st December 2026 is an amount set aside to cover investigation work into the cause of an accident in which one of the company's design overturned during the race. So due to design fault, company is facing some kind of fines, penalties. That's why company have recorded a provision. And if that provision have to be paid after acquisition, this could create serious cash flow issue for the company. If company will be facing a further design fault cases, who will be paying damages? Who will be paying damages? This is another problem. You have been told that the expenditure to date has utilized most of this provision, and the indication are that the cause was not a design fault, but there is an issue. If you have created provision, this means there are issues. Mr. Bond required the conclusion from your review, not audit review, non-audit, with any impact they may have on the structure of the bid offer that should be put to shareholder of Top Draw. So benefits we have identified, problem we have identified, now structure of bid. If company want to acquire this, they should move towards cash plus share option, not only cash. And these directors of Top Draw should be given management level position, because sometimes people remain in one organization due to the position, due to the power. If you don't provide them the power, the position, they could leave because they have worked as a powerful person before. Now, if you try to put ask them to work under pressure of any other person, they might will not work. What could be the other factors? Adjustment relating to R&D is required, and forecast of the company, because there is could be chances of other design fault, and detailed investigation about the design fault, expert opinion regarding detailed investigation about the design fault. These could be the other factors that will help in making investment decision. So let's take a break. After break, we will discuss some past paper questions on due diligence. Okay, so moving towards questions on due diligence assignment. Due diligence assignment, where we are helping any investor in acquisition or merger cases, and we are providing a report on the target company regarding benefits, problem, and structure of a bid. Who conduct audit? Auditor. To conduct audit, it is necessary you must be auditor. The word auditor means member of any professional body. Word auditor means member of any professional body who has assigned a license from the body to operate as auditor. We will become auditor after becoming a member with ACCA. Non-audit engagements can be performed by any practitioner. Practitioner means accountant or auditor. Accountant means a person who know how to perform audit work, how to perform accountancy work, but he's not a member of any professional body. Might be he has completed his experience, but left with one paper of ACCA from last 10 years. Or might be he has completed 13 papers of ACCA, but I haven't completed the PER to become member. So audit, only auditor can perform, only auditor can sign audit report. But non-audit engagement can be performed by the practitioner, mean accountant or auditor. So let's move towards a question called checkup. Part A of the question, explain 3 potential benefits of an externally provided due diligence review to Jacob company. Mean company can ask any of the internal employee to perform this due diligence. But if company is taking these services from any external audit firm, what could be the advantages? If they are sending any internal employee, he will not be independent. He will look at areas relating to his concern more. Might be he will not looking into detail of all areas. So external person will be more independent. An external person is having a vast variety of industry knowledge experience. So he will help you to provide more depth analysis based on his experience, based on his knowledge. What else? What could be the other benefits of externally provided due diligence report rather than through internal person? If you are sending any of the internal person, if he is performing this due diligence, his main role that he is performing on permanent basis in the organization could be affected. And through external, management will be focusing on their main areas as well. And this additional assignment will automatically be performed, mean there will be no disturbance in your routine duties. Is that? Part B for 12 good marks, recommend additional information. What does mean by additional information? Name of documents relating to any issue, relating to any matter. So recommend additional information which should be made available for your firm's due diligence review. And explain the need for the information. And if you are going to perform due diligence, what documents you will check, and from those documents, what information you will get. Suppose we are going to perform due diligence review on target company, and relating to target company, we got information target company have obtained a loan from the bank for 5 years. So that loan agreement will be what additional information that we will put as a heading. And then we will explain, we need to get detail about the amount, interest rate, time period, and especially condition attached to the loan, because after acquisition due to change of ownership, might be due to breach of condition, company have to pay back the loan immediately. because this is of concern from investor point of view. Because there could be some condition attached to the loan. If ownership is going to change, could be breach of condition requiring paying back loan immediately. We got information company is having 3 owners. What is additional information? Ownership documents, mean share register. We need to get information who is the majority shareholder to whom we need to discuss the bid price. If all 3 having equal, then this means we need to negotiate with all 3. And this will put them on strong bargaining position. If any one is having majority shareholder, this means we need to convince him only, not the others. Is that? Company is having 100 employees. So employment contract is an information. We need to get a detail about the employees contract, whether any termination of employee requiring any notice period, because after acquisition, if we need to reduce number of employees and we are moving towards redundancy, whether there will be any redundancy payments or not, because this is of our concern, because after acquisition, we need to manage this business. Company has invested in property. So land registry document we need to see. We need to see whether that land is registered on business name or owner name. Because if it is on owner name, after acquisition, he will take with him. If it is on business name, ultimately who will be having this land, and this ultimately reflect the bid price as well, because it's coming with the business, bid price will be more. If it is on owner name, ultimately it's not coming with the business, so bid price will be lesser. We don't need to incorporate the amount of these land. Is that mean whatever the information we are getting about target company, to identify problems, benefit, what documents we will see, and why we gonna see those documents relating to problems, benefits. Mean we are not going to highlight problems or benefits. To perform due diligence review, what documents you will see relating to information of the company and why you want to see that document from target company point of view. Always from from investors point of view. Mean if you are performing due diligence review, consider you are the investor, because you are providing consultancy services. So Jacob Company, an audit client of your firm, is a large privately owned company whose operations involve repair and maintenance services for domestic customers. So Jacob is your audit client that provide maintenance services to domestic customers, repair maintenance services, like plumbing services, something like that, sewerage services. The company offers a range of services such as plumbing and electrical repairs and maintenance, and the repairs of domestic appliances such as washing machine, cookers, as well as dealing with emergencies such as damage caused by flooding. All work is covered by a 2 years warranty. This is our client doing. The directors of Jacob Company have been seeking to acquire expertise in the repair and maintenance of swimming pool and hot tubs. And this is a service increasingly requested, but not offered by the company. But they want to provide these services as well. So they have recently identified Lockheed Company as a potential acquisition. Preliminary discussion have been held between the directors of the 2 companies with a view to the acquisition of Lockheed Company by Jacob Company. This will be the first acquisition performed by the by the current management team of Jacob Company. Your firm has been asked to perform a due diligence review on Lockheed Company. Prior to further discussion taking place, you have been provided with the following information regarding Lockheed Company. And through this information, you need to write down the name of a document, what you want to see, and why you want to see that document. You need to explain. The document name will be heading. So Lockheed Company is owner managed, with the 3 of the 5 board members being the original founders of the company, which was incorporated 30 years ago. So what document you gonna see? shareholder register. We need to get detail about the shareholding, like who is the major shareholder to whom we need to discuss the bid price. And why we want to see this document, we need to explain in English. No particular terminology is used. Simple. The head office is located in a prestigious building, which is owned by the founder's family estate. The company recently acquired a separate piece of land on which a new head office is to be built. So first, head office registry document. We need to get detail whether it is registered on company name or with any person name. And we need to get detail whether it will deliver with the change of ownership or owner will retain with him, because this could affect the bid price as well as the business operations, because might be business repute is linked to that prestigious building. And then separate piece of land. So land registry document. We need to see whether that separate land is registered with company name, business name, or with owner name. Because it's with business name, it will be delivered to the Jacob company and will reflect the bid price accordingly. The company has grown rapidly in the last 3 years, as more affluent customers can afford the cost of installing and maintaining swimming pools and hot tubs. So company has grown rapidly. That's why might be they will charge extra goodwill as well. So the document we can see regarding this rapid growing rapidly. Past financial records to see the growth of the company, the profitability, the sale growth of the company, because it could reflect the bid price based on the repute as well as goodwill. Is that? I mean, how much is the growth? Based on that, they will be charging high goodwill. So the expansion was funded by a significant bank loan agreement. So we need to get the detail about the amount, interest rate, and time period, and especially covenants attached to the loan. Because due to change of ownership, might be due to breach of condition, it has to be paid back immediately. Will create serious cash flow problem for the business. The company relies on an overdraft facility in winter month. Why? Because customers use hot swimming pools in summer, not in winter. So that's why in winter, there will be lesser revenue and company rely on overdraft. When less operating cash inflows arise from maintenance work. So overdraft contract copy to see whether this overdraft will continue after ownership or change of ownership after acquisition or not. Because might be in future, we need to survive on overdraft in winter month as well. Because if this will not be continuing, ultimately how we will survive in winter, that we need to see that. Lockheed Company enjoys a good reputation. Though this was tarnished last year by a complaint by a famous actor, Shah Rukh Khan, who claimed that following maintenance of his swimming pool by Lockheed Company's employee, the water contained a chemical which damaged his skin. A court case is ongoing and is attracting media attention. What document you gonna see relating to this matter? Court case copy. We need to check the severity of the case to see how it is going to affect repute of the business. Because the repute could also affect the future profitability, future revenue of the business. And the company's financial year end is 31st August. Its accounting function is outsourced to Austin Company, a local provider of accounting and tax services. Company have outsourced their accountancy and tax services to any of the accountancy company. So contract with the Austin company. Because after acquisition, if we want to run this accountancy and taxation services in-house through our staff, so whether we need to pay any contractual breach damages or not. Is that finish? This is what due diligence question. Mean from investor point of view, relating to these issues, what document you will see and why you will see those documents, you need to explain in English. Let's move towards one more good question. And we have finished this due diligence topic. So we're having one more question called mission. Mission. If we see the question, the requirements are between the question. This means we should start reading and move towards requirements. You are a manager in the business advisory department of Gulin and Company. You are what? Manager, not audit manager. In business advisory department of Gulin and Company. This means this is not a question of audit. This is non-audit engagement question. Because in audit, you are audit manager, you are audit manager. So your firm has been approached to provide assurance to Baltimore Company, a company which is not an audit client of your firm. He has stated once again, it's not audit. On a potential acquisition. Potential acquisition, this means due diligence assignment. The nature of question will explain this is a due diligence question. If in acquisition or merger cases, you are going to perform any review on the target company, this is due diligence. You have just had a conversation with Mark Clear, Baltimore Company's managing director, who made the following comments. Baltimore Company is a book publisher, specializing in publishing textbook and academic journals. In the last few years, the market has changed significantly, with the majority of the customers purchasing books from online sellers. People are using soft forms books rather than hard copy books. Nowadays, even ACCA students do not buy hard copy of books. They are having a free soft copy. They are using that. They are saving money. So the company is saying we are the book publisher. And in last few years, the market has changed significantly. This has led to reduction in profits. And we recognize that we need to diversify our product range in order to survive. As a result of this, we decided to offer a subscription-based website to customer, which would provide the customer with access to our full range of textbook and journals online. We'll be providing online access to the books and will charge subscription to the customers. On investigation how to set up this website, we found that we lack sufficient knowledge and resources to develop it ourselves and began to look for another company which has the necessary skills with a view to acquiring the company. Obviously, to manage online business, you need IT services, and they are saying we lacking with IT. So we are going to acquire any of the IT services company. We have identified Mission Company as a potential acquisition. And we have approached the bank for a loan which will be used to finance the acquisition if it goes ahead. Baltimore Company has not previously acquired any other company. We would like to engage your firm to provide the guidance regarding the acquisition. I understand that a due diligence review would be advisable prior to deciding on whether to go ahead with the acquisition. But the other directors are not sure that this is required. So we can explain them what is due diligence, why it is required. And they don't understand what the review would involve. How you perform due diligence review, how we perform due diligence review. by three limited procedures: inquiry, written presentation, and analytical procedure. They are also unsure about the type of conclusion that would be issued and whether it would be similar to the opinion in an audit report. No, in audit, we provide reasonable, positive, high-level assurance. In non-audit, like a review, we provide limited, negative, and low-level assurance, like nothing has come to our attention that causes us to believe financial statements do not give credit review. To help me brief the other directors and using the information I have provided, I would like you to discuss three benefits to Baltimore company of a due diligence review being performed on Vision company. We need to provide three benefits for Vision company due diligence review for Baltimore company. Is that the similar requirement of Jacob company? The previous question? No, in that question, they asked for external due diligence benefit. Now they are asking for benefits of due diligence. So what are the benefits of due diligence? They will be having in-depth analysis about the assets, about the liabilities of the target company. Through due diligence, you will be able to highlight the problems and benefit of the acquisition in much detail. Through due diligence, the investor will be having an idea about the structure of the bid, whether they should acquire in cash plus share option, and what other factors they need to consider. 2 marks each paragraph we can prepare. Part B. Before moving towards part B, let's see what is part C. Describe the type of conclusion which would be issued for a due diligence report and compare this to an audit report. In for 3 marks, you need to compare audit and non-audit engagements. So in audit, we provide opinion on the financial statements. And in that opinion, we provide reasonable, positive, high-level assurance. While in non-audit engagement like due diligence, auditors do not perform extensive audit procedures. They perform 3 limited review procedures called analytical procedure, inquiry, and written presentation. And the assurance provided in non-audit engagements like due diligence is limited, negative, and low level, like nothing has come to our attention that causes us to believe financial statements do not give credit faith. Now moving towards part B of the question for 16 good marks. Identify and explain the matters you would focus on in your due diligence review and recommend the additional information you will need to perform your review. In Jacob question, he asked for identify the additional information that is required and then explain the matters. So we put the heading of the document. Now this is a reversal of that Jacob requirement. Now you need to put the heading of the matter, explain this, and then you need to name the document that is relevant to that issue. Like in Jacob, we got information company have obtained bank loan, so we put the additional information in loan agreement. So we need to get detail about the amount, interest rate, time period, as well as condition attached to the loan, because might be after change of ownership due to breach of condition, we need to pay back the loan immediately. Now we need to put the heading of the issue rather than the document. Loan. We'll put the heading loan. The same thing we will explain, the same English. We need to get detail about the amount of the loan, interest rate, time period, and condition attached to the loan. Especially if due to change of ownership, due to breach of any condition, we need to pay back the loan immediately. And the additional information for this will be loan agreement. Is that only the answering? The way of answering is different. Otherwise, it's similar to Jacob. Now you need to put the heading of the issue rather than the document. Document you need to state at the end as additional information. Is that? Okay, moving towards question. but this is a bit difficult as compared to Jacob. Mark Lear has sent you the following information about Mizzen company background. Mizzen Company was established 4 years ago by two university graduates, Vic Sandhu and Lurley, who secured funds from a venture capitalist company, BizGrow, to set up the company. Vic and Lou created a new type of website interface which has proven extremely popular. But before that, there are two owners as well as they got fund from the venture capitalist as well. So we'll put the heading, not a shareholder register, shareholding. So we need to get detail about who is the major shareholder, what is the shareholding of BizGrow, so that we can identify whether we need to discuss the bid price with Vic, with Lou, with both, or with BizGrow as well. And the additional information for this will be shareholder register and contract with BizGrow. Shareholder register and contract with BizGrow venture capitalist. Vic and Lou created a new type of website interface which has proven extremely popular and which led to the company growing rapidly and building a good reputation. They continue to innovate and have won award for website design. Vic and Lou have a majority shareholding in a Mizzen company. So regarding minority, so regarding shareholding, we have discussed. Now they have developed a website, and based on that, they are growing rapidly and having a good reputation. So company growth. So we need to get information about company growth, how much percentage is the growth, because it could affect the bid price based on the goodwill, based on the repute. And additional information for this will be past financial records as well. And they have won award for website design. So put the heading award. So we need to get the detail about the award, the body who awarded to the company based on the website design, because this could also reflect the bid price based on the repute. So document will be certificate from awarding body, as well as a press release. Press release will explain the nature of the award, from where they got this award. Mizzen Company employs 50 people and operate from premises owned by BizGrow, for which a nominal rent of 1,000 is paid annually. First, they are having 50 employees. So we'll put a heading employment. So we need to see the employment contract regarding if after acquisition we need to redundant some of the employees, whether we need to pay any redundancy payments due to contractual breach. Additional information for this will be employment contract. And they got premises on rent, on nominal rent from BizGrow. So rent will put a heading. So we need to get detail about the rent, whether it is on market rate, either based on any personal relation with BizGrow, whether the same rent will continue after acquisition or they will increase. Additional information for this will be rental agreement. The company uses a few assets other than computer equipment and fixture and fittings. Asset. So we need to get detail about the assets. What are the significant asset company is having, because based on the value of the asset, bid price will also reflect. So additional information will be asset registered. Good. The biggest expense is wages and salaries, and due to increased demand for website development, freelance specialists have been used in the last 6 months. Freelance mean part-timers. According to the most recent audited financial statements, Mizzen company have a bank balance of 500,000. First, we'll put the heading freelance. So we need to get detail about the freelance, whether they are having a contract with a company or they are coming to the company based on some personal relations, whether they will be continue after acquisition or we can change them. So additional information will be freelance contract copy. And company is having a bank balance of 500,000. So we'll put a heading bank balance. We need to get detail about this bank balance, whether this is the normal bank balance company maintained, and it is a one-off due to any large receipt from the customer. Because this could also reflect the bid price. Additional information for this will be bank statement, whether it is a routine maintained balance or one-off. The company has 3 revenue streams: developing and maintaining a website for corporate customers. What they does? They develop and maintain website for corporate customers. Mizzen company charge a one-off fee to its customer for the initial development of a website and for maintaining the website for 2 years. The amount of this fee depends upon the size and complexity of the website, and average $10,000 per website they charge for development as well as 2 years maintenance contract. The customer can then choose to pay another one-off fee averaging 2,000 for Mizzen company to provide maintenance for further 5 years. So what we can say, website development. So we need to get detail about this website development contract with the customers, whether the customers are engaging with the business on a business name or due to any personal relation, because this could be the major revenue of the business that we need to see whether will accrue after acquisition or not. And if company is providing a website with a 2 years maintenance contract in 10,000, then Baltimore could opt for this option instead of acquiring that company, because their main aim is what? Developing a website where they can provide online books to the customers. Is that? Number 2, Mizzen company has also developed a subscription-based website on which it provides access to technical materials for computer specialists. Might be some software they uploaded over there, and different computer specialists are accessing those software, and they are charging subscription to those computer specialists. Customers pay an annual fee of $250, which gives them unlimited access to the website. This accounts for approximately 30% of Mizzen company total revenue. So put the heading subscription-based website. It is generating significant revenue, that is 30% of the business. So we need to get detail whether this subscription-based website is registered on business name or on any of the personal name. Because if it is on business name, this will coming after the acquisition to us and we will be able to generate 30% revenue. If it is registered with any of the person name, might be will not transfer to us after acquisition. If it is not going to be transferred to us after acquisition, we will be losing this 30% revenue. Additional information for this will be website registry documents. The company has built up several customer databases which are made available. They are having customer database as well. Need detail about customers. For a fee to other companies for marketing purpose, and they provide this database to other companies for marketing purposes, and they charge a fee. This is a smallest revenue stream, accounting for approximately 20% of the Mission total revenue. So customer database. So we need to get detail because this is again significant source of revenue for the business. Whether this database is registered, maintained by the company or maintained by any of the person. Whether we will be having this database and we will also be generating this 20% revenue of the business after acquisition. What could be the additional information in document? Additional information for this will be data-based registration document. Extract from audited financial statements. They have provided audited financial statements for the company for year 20x0, 1, 2, and 3. If you look at the revenue, increase, huge, increase and increase. But the amount increase will not provide in-depth analysis. We need to see what revenue growth from here to here, here to here, and here to here. And if you look at the growth rate was more here, lesser here, mean revenue growth is declining over the years. Though in terms of amount is increasing, but revenue growth in terms of percentage is declining. Operating expenses increasing, operating profit, loss to profit, then profit, and then profit. Even the profit margin we need to calculate of all years. And if you look at the profit margin, that will also be decreasing over the years. Finance costs remain same, 250, 250, 250. Why? No change in liability. Company is not paying back. If they are paying back, finance cost could be reducing over the years. And profit before tax, tax expense according to profit, and then profit after tax is increasing. There were no items of other comprehensive income recognized in the year. So based on this, we can check the revenue growth has declined over the years. And if it is declining, this means might be company is losing its customers. And this could create cash flow problem after the acquisition. So additional information for this will be future forecast. And then finance cost, we'll put the heading finance cost is remain same from last 3 years, 250. And this is reflecting like companies not paying back the liability. So we need to get detail about the liability relating to this finance cost, the time period, the interest rate, and any conditions. Additional information for this will be finance contract copy. Finance contract, like if it is a loan or could be irredeemable, redeemable preference share, something like that. Is that? Mean both questions are similar, checkup and this, but the requirement is different. In that, we need to put a heading of document and explain why we need to see this document. Now we need to put the heading of issue. Why this issue we need to consider, and then we need to put the name of the document. Try to attempt these questions. Next class, we'll move towards other non-audit engagements like PFI. See you next class. Next Saturday and Sunday, last two classes.